Hey everyone, we have a very interesting discussion that we're going to have today. We have Nathan Michaud here. Nate, thanks for having this conversation.
You bet.
So the goal of this convo today is to talk about short squeezes. And, we see these all the time in the market. I play them a lot, you play them a lot. And as one of the most, I would say one of the most notable short sellers out there who's been responsible for a lot of the education in modern day shorting. And, you have had some incredible calls over the years using those strategies. I figured that there's no one better to really talk about the topic of short selling and short selling squeezes than you. So there's a couple of things that I really want to set the stage with here before we talk about what are the best squeezes, how do they happen, what are the signs to look for, and how to either avoid them if you are a short seller, or how to potentially capitalize on them if you're a long trader who looks for signs like that. So here's the stage that I'll set. When I look for short squeezes, there's a couple of things that I typically see. First, there's some kind of invitation to get shorts interested in the first place. You can't have a short squeeze without short sellers present. So something needs to get people interested. Yeah. The second thing that I see is you have trappy action. And that just means that, something gathers more and more short sellers into a stock and it doesn't let them out yet. So it's kind of accumulating short sellers. The third thing I see is some kind of a trigger point. And then what that means is that once the squeeze starts to actually get going, short starts saying, this is getting a little bit sketchy. Yeah. I'm going to have to cover soon. And then you get to the last stage of the squeeze, which is the actual cover. And that is the short squeeze itself. So would you kind of agree with, is that kind of the stage that you look at when it comes to short squeezes as well?
Yeah, I look at a lot of, how fast it is from, where it starts to peak. And the faster it goes there and the more volume that it trades up there, the less interested I am. It's more about the ramps up, pulls back, ramps up, pulls back, and multiple chances to almost, like you said, invite more shorts in, invite in lower highs, but then all of a sudden you have like a dip and a rip back up. Just repetitive action like that.
Yeah, and I think that that's super important because we'll see this sometimes where something will like prematurely have like a squeeze in the middle of the day and it clears out all of the short sellers that were in there, and that can kind of ruin an eventual squeeze. And so, as someone who's a short seller, you might be interested after a stock that was trappy has a big clear out.
Correct.
And then, you're looking for the backside of that to fade down. But it's the names that maybe they ramp up in the morning and then they keep making a lower high, keep inviting in more people, but they eventually move up to some kind of trigger point that gets them, in a bad situation. So
they never really give the shorts an exit. It's always just a continual grind. And when you look back, it's like, how much have they actually made? They haven't really got that exit yet, but yet it's starting to go back up. And yes, it's going to start to trigger those different levels to the point of like panic, which then turns into many times a circuit halt or something like that.
Absolutely. And so there's different kind of categories of short squeezes. You have one category where it's like, large cap stocks or something that might have persistent short interest on it. So take like a CVNA that might be, maybe a year or two ago might have had 20 or 30% short interest on it. And it never really has one big blowout, or usually not, but it usually is like, trending in some way. And then maybe you get a news event and that can trigger the squeeze. So that's kind of like one type of short squeeze with more like the large caps. But I feel like the type that we're really focused on for this conversation is more the small cap companies where it's active traders, not so much, institutional short interest, but it's more active traders that get invited in there and have that eventual squeeze. So, when you are looking in the market, are you looking for stocks that, you can see have had trappy action that you are looking to eventually look for a squeeze on? Or is it more as you're trying to short some of these stocks and you see them becoming trappy, do you flip your bias?
Yeah, a little bit of both. If I know not to short it, just based on that action, then that's something that I might look for a short squeeze, something that just the fact that not to short it because it's showing all of those signs. In the past, I would just avoid it. But most recently, the last year or two, I've been trying to work more longs. If I know not to short it because I think it's going to squeeze, why am I not long? So that's one of the things I've worked on. But it also comes down to, how many, what's the market like? Is there a lot of volume right now? Is there a lot of, like what happened yesterday, the week before, the week before? If it's really slow, then obviously you don't have as many. When shorts are winning a lot, and confidence is growing, I feel like that's something to be aware of and familiar with, because it just takes that one to kind of reset that cycle, and you have that crazy move, and you've got another 2 weeks of great runners. One of the things that I look for is how many gappers do we have on any given day, because there's not that many small caps that are gapping up. 100%, 50%, whatever it may be. And the less you have, the more crowded they're going to be. So that's something that I watch out for, just to kind of anticipate which ones could be, super trappy versus, a day you wake up, you might have 10 or 12 different runners. It's going to be dispersed amongst all of those. I'll be more confident on the short side on names that are fading off.
That's a great point. And something that you do on Twitter every now and again is after those cycles where shorts are winning, whether it's with liquidation trades or anything, everyone just made a ton of money. Everyone's at super confidence.
Have your guard up.
Yep. You'll say that there's probably a black swan or something that's going to happen because people are going to try to, do the same thing that they just did on the last 3 or 4. They're going to take that money that they made, plow it back in. So now you have more size, more confidence, everything. And then you get to a day where maybe there is a much more concentrated, group of gappers. So maybe it's only 2 or 3, or maybe it's like a really low float, or maybe it's like an odd structure, something else is going on. Yep. And everyone piles into that one name and you have a dip and rip. So when you see dip and rips, what is that really signaling to you? Is that shorts piling in, but there's immediately a demand level soaking that up? Or how do you see that?
Yeah, I mean, I think it's sort of the anticipated crack. So you're like almost proven right, but then immediately proven wrong. And so I think that it's at the point where everybody's kind of leaning on it, and then it almost gives them a confirmation, and almost where you're adding into that. And then the swipe back up, you're immediately down. And you do a lot of times have a point to exit, but it's more you kind of pause and you almost want to see what it's going to do, and then it goes on to the next leg up. So that's something that I'm super aware of now, and a lot of times in that situation, I'd rather actually miss that and see if it comes back up and fails to follow through. Like actually break under support and let it try to reclaim. And if it doesn't, then I'm interested. But more often than not, in the last year, I mean, there's just so many dip and rips, dip and reclaims, that it's just running shorts over left and right.
Yeah, and I feel like the crowded nature of short selling over the last couple of years, as people see, strategies that work, things that have, good probabilities and typically good expected value, that can, attract more and more people to that. And when you get so many people kind of doing that, it can have the opposite effect where usually it works, but the times that it doesn't, it really doesn't. Yeah. And that will, trigger something.
You're either going to be right or really, really, really wrong.
Yeah. And that's something that you talk about all the time. So, okay. So now we kind of know like how a short squeeze can kind of happen. You need something to attract shorts to it. The dip and rips, the trappy action, the trigger point, the cover. What kind of stocks or structures are ideal for a squeeze? Is it more low floats? Is it things with high volume? Like what are the parameters that you're kind of looking for in an ideal candidate for a short squeeze?
Yeah, I would say like there's a much different ease of information now, right? That you can just log into different websites and see delusion now and how likely they are to raise. And I think a lot of people just many times look at that and they just make their decision like, okay, this is a piece of crap. It should go down. And the faster they come to that conclusion, the faster they're short and the faster it's crowded. So that's one of the things, as well as like a crowded catalyst, like, oh, this was terrible earnings. Why is it going up? And, a lot of times companies, it doesn't matter if they have earnings or not. That's not why they have investors. They're investing in, the future, and earnings don't necessarily matter at this point in time. They're investing in the idea and what it's going to become. So when there's a lot of people that are all coming to the same conclusion and things are not fading off, that's another one of those red flags where it's like, maybe I should be hands off, stay away from this.
Yeah, that's something you talk about a lot as well. The overly obvious names are the ones that get people in trouble, because it's like, of course, if this name's going to go bankrupt soon, or if this name has terrible earnings, or if this name has a delisting coming up, or something where it's like everyone's thinking the same thing, and it starts to do the opposite while it's crowded. Yep. So, are you looking at stocks that are usually fairly low float when it comes to situations like this, or can it be up to 20 million float, 50 million?
Yeah, I mean, it definitely can. I mean, we've had even today, there's runners that are 50 million float, and acting like they're, 5 million. So it really just depends on volume. And anytime there's outlier volume, that's when I want to be super cautious. And, as you might try a short or two, and most of the time when you're right, and I think Lance says this a lot, but like your best trades go in your favor right away. And so I think a lot of the times that I've learned many times over the past, like just waiting for what I'm expecting to happen. The longer I'm waiting and wrong, the more likely it is that it's going to end up, going the opposite way. So, a short, I want it to be in my favor right away. When I'm in a short and it's not in my favor, that's another one of those red flags to be cautious of, especially when you know that there's a lot of crowd in the space.
Definitely. So a topic that you mentioned there was, indirectly is float rotation. So that's the high volume on a low float stock.
Yeah.
Could you talk about float rotation? What does that mean and why does that actually matter?
It's any time that the float rotates around and around and around and around. If somebody wanted to sell it, they would have sold it. So there's enough liquidity. It's all about liquidity. And at that point, it just becomes almost like a supply and demand kind of game. And the more supply that comes out, well, I guess the more volume there is, the more supply could be sold if they wanted to sell it. But what happens is the supply actually comes from the short sellers. So as soon as what the selling dries up and the short sellers are done and there's nothing left, there's nobody on the offers. The sellers are already sold, and now all that's left is buyers and short sellers. And as things start to kind of trickle up, that's when we start to get those really big moves off of the float rotation type trades.
Yeah, and we tend to see those, especially in the stocks that tend to have a huge gap up and then get saved a couple of times. So
Yeah.
those are the ones that end up running like 800%, 1,000% in a day. They might gap up 150%, 200%, and everyone's thinking, again, the invitation, this is up too much, but it gets saved. Now it's up 300%. It gets on more people's radar, more volume churning.
Yeah.
It's still low flow. And, like the float rotation, it's if a stock has a 2 million float and it's getting 200 million of, volume churning, like you just said, where is the supply and the demand coming from? And if most of the supply, because again, if it had a huge gap up, there's not a ton of sellers that are, bagged usually if it has a big move. So that supply is coming from short sellers who are just hammering it down. You see those dip and rips and you have that, fierce volume rotation and eventually something stops and now there's no more supply and you have two layers of demand. You have all the people who are up big,
Plus
who are
the
not
covers.
selling, plus the covers.
Yeah.
And you have a name that's already up a lot and so it gets extra thin. So instead of higher the better, it becomes higher the thinner.
Yeah.
So I feel like we see that constantly. And there's another aspect to the float rotation, which can be like the T+1 or the failure to delivers, which might not happen on that day, but maybe a couple days later, after a big move, a big gap or a ton of volume, a few days later, you'll have a failure to deliver or T+1 set up. So could you just talk about kind of how that happens or what is the idea of that?
Yeah, I mean, there's just so many brokers these days, clearing firms that, allow you to short sell. And quite often there's a lot of failures. A lot of brokers don't actually deliver the shares. They're not actually getting shares from the street and, giving them to you. Typically what a borrow is you're borrowing it from somebody else. And a lot of times it's just based off of a number, some sort of mathematical equation. And if you think about how many you can get at one broker, multiply that out by all the other brokers that are out there, there's a lot of supply out there that will cause a clearing firm to potentially have a failure to deliver. And at that point, usually it's, you either get a call or email or whatever, but you're forced to buy in that stock that day, whether that's at open or you take the chance view up throughout the day. Trouble is, if it starts to run 100, 200% that day, you might as well have just marketed it out at the open. So that a lot of times is this unnatural almost demand that is forcing people out that then starts that secondary move on these T+1 moves. So what happens is you've got this cover that comes in and then these new shorts, but then if there's still not enough supply from sellers, then you start to have that perpetual squeeze. It turns into that secondary move, which we have had quite a bit of recently, almost perpetually squeezing every single day into a 2 to 15 type move.
Absolutely. And so, yeah, you might have that, short squeeze on the first day where it ramps up a lot, ton of volume. And then you might have a couple days later that secondary squeeze. And then that same process can repeat where, oh, it's up even more now. It looks even more attractive. It's even more thin. There's more supply, more shorts. And it just keeps on going until it eventually gets to the actual blowout cover. And that is when basically almost all the shorts that were in there, all the price sensitive shorts, get stopped out. They get blown out. They get forced out. And so could you talk about the opportunity maybe on the backside of that move? Because while short squeezes can have huge moves to the upside, as soon as they start to go really parabolic and they get all the shorts out of there, that tends to be the point where the boat is flipped. Instead of, being short crowded and, longs are in favor and everything like that, it gets to a point where it's very long crowded. There's no shorts left. It's up a ton. And now it stops going up. And so can you talk about why those tend to be such great fades after the squeeze is done?
Yeah, I mean, on the way up, there's no reason to sell, right, for longs. So even if they do have a good average, they still want to, they've just saw one that went crazy. So they want to be patient, be patient, be patient. So a lot of times they'll wait for it to roll over. All right, I'll sell the next, pop. Doesn't happen. Next pop, next pop, next pop. And then you end up having that nice unwind after the exhaustion candle comes in. For me, what I look for is I want to see, it flush down, and a lot of times you'll see it start to base at a key level. And I want to see it actually break that key level and then peak out. Because what happens if you think about yourself, put yourself on the long side. Where would you say, all right, I should get out now? And that's usually the best spot for, at least for me, to get short. Yes, I could short in parabolic moves, but a lot of times, that they can be crazy sometimes. It's not always the best idea, especially in some of these markets with circuit halts. So for me, I like to put myself on the other side. If I'm long, where is it like, oh shit, I should have sold? And at that point, that's when you start to have that almost waterfall effect of both hammering shorts and people panicking out on the long side, just as if they were shorts panicking out on the short side.
Yeah, and that's a great point. It's really the cycle flips. And so if for a short squeeze, you need the invitation, the trappy action, the trigger, and the cover. Once you have that cover, it becomes flipped. And so now, longs have that invitation of something's squeezing, it's perpetually going up. That's their invitation. And then it gets trappy by, looks like it's going to break out, but it fails. Looks like it's going to break out and then fails. And then you have basically, it gets to a trigger point, like you were talking about, it gets down to a key level, breaks underneath it. And now they're starting to think, I need to start to exit this. And at the same time that there's very few shorts in there, the shorts start coming back as the longs start stopping out, and you have that almost symmetrical move back down. And so I think it's very worth noting that, it's not about just being a bull, being a bear, squeeze, no squeeze. It's understanding that this is a cycle based on supply and demand. And it really doesn't get talked about too much of, from a neutral, unbiased way. How do these squeezes happen? And then, what are the best points to enter that if long? And then once they kind of, peak, what's the best point to enter if, to get short? So could you talk about when, you've identified a squeeze, what are typically the entry signs that you look for on a long? So, you obviously don't want to enter as it's blowing off. So when do you actually enter, and what signs do you look for?
Yeah, typically I look for those first kind of dip and rip candles. And, just where it's like they're inviting the shorts in and then it rips up, and then inviting shorts in again and rips up. And the goal is to kind of put a line, at each of those levels. And as long as it does not breach that, then I'm still on the bull bias kind of side. And so that's what I typically look for. Also, for example, a recent, just yesterday, for example, we had a particular Chinese name that was about $5.50 when it opened, ended up fading off down to about 85 cents on the day. Then this morning we have a very similar $3, $4, $5 type of stock, Gapper, that is another Chinese name. And so everybody right in their mind is like, all right, yesterday went down 80%. This is going to be another nice no-brainer. They're going to, gap this up and crash it down. So it's the crowd trying to take that same trade. So being able to kind of relate it to what is the crowd thinking? What was a recent example that just kind of invited all the shorts in and paid them out? And maybe they didn't realize they were being reckless at $5.50 or $4 or whatever price it was yesterday. But today they're trying to repeat that same trade that worked out, ignoring the price action, ignoring the dip and rips because yesterday it worked out. And then all of a sudden you swipe up, you're 5, you're 6. And now you have a situation where you're down $2 a share and you have a big decision to make. Do you go ahead and take proper risk management, take it off, or do you try to like wait it out, and then all of a sudden it's 8, and then it's 9, and it's 10, and then we have that big clear out candle.
Yeah, definitely. So taking the cycle into account, looking at the action, and then another topic I wanted to touch on was time of day. And so from what I understand, and when you and I have traded together, it typically tends to be either it traps and squeezes off the open, or it happens later on in the day. Could you talk about why those times, are kind of ideal for squeezes versus somewhere in the middle of the day?
Yeah, I mean that it's your audience, whereas the audience, a lot of times there's like the midday lull. So, there's definitely squeezes in the middle of the day, but where is the high probability? Where are most people looking? Typically 3 to 4 p.m. People might be, thinking about taking their position off before the end of the day. So yes, you've got, a lot of stuff, actually even pre-market, I would add in a third. You've got pre-market, potential flush into the open, then a trap off the open, another trade maybe from 9:30 to 10. And then again, another one like maybe 3 to 4. I think the biggest thing to sort of take away from like the 3 to 4 is if that squeeze does, if you're long anticipating a squeeze and thinking like this could be a nice gap or something that's going to follow through the next couple of days, but then it all of a sudden happens at 3:20, 3:30, you have to be willing to adjust your game plan, because that squeeze that you were anticipating just happened. So yes, it may turn into a perpetual squeezer if they retrap and they invite more shorts in. But the trade that you were anticipating happened, and I think a lot of people have a hard time sort of realizing that in real time, because they want more, and then it ends up fading back off into the close.
Yeah, definitely. And that goes back to the life cycle of these that we were talking about, how, as that squeeze is coming in, again, if that happens, if your thesis was there's going to be a short cover and that's going to drive it up, once the shorts have covered, that is the end typically of that life cycle, unless it retraps again and then collects more shorts.
So like if I was going to take something overnight, and let's just say it's an idea at 2 or 3 p.m. and I like it as a potential gapper play, the stronger and you see me say this quite often, the stronger it is into the close, the less I like it as a gapper, because that's all being fueled by either crowd, all taking it for a gapper. And if you're wrong, all of those people are going to be competition in the morning, or it's the short cover. And once they're done, then your sort of thesis is void.
Yeah, absolutely. So we've covered a lot with this. I appreciate you taking the time to go through it. Do you have any, kind of closing thoughts or any other things that people should really pay attention to when it comes to either participating in squeezes on the long side or avoiding them on the short side?
I really just think, one of the biggest changes that I've made over the probably last 3 to 5 years is, you don't need to find the top. And a lot of people are just so concerned with trying to figure it out and time it. But you really just want to be on the right side of the trade. And the more range there is, the less important it is to find that top. Because once it does shift, you have that entire retrace to be able to participate in. So the more it goes, the less important it is to time it perfectly. There's going to be those great opportunities off the open and things like that where you can anticipate, but don't step in front of stuff. It's a wild market. Be cautious of the low float type names. A lot of people trade, between circuit halts and things like that, and it's not fun when you're on the wrong side. So, in my opinion, the best way is just to be patient. Let everybody, I say this a lot, let everybody pay for the information and then step in. And once you see that happen, I always put, certain levels. Where were they supporting before? Once that first piece of support breaks, and not just a break one time, but actually comes back and tests, and it fails to follow through, that is a better entry than trying to figure it out on the way up.
Excellent. If you enjoyed this conversation, we have more content like this at Investors Underground. Leave a comment, let us know what you think. And Nate, thank you very much for having this conversation.
Thank you.